Welcome to the Agility Insurance Podcast. Get amplified with expert insurance insights and more to grow your business. Now here's your host, Jason Wright.
Mike, welcome to the Agility Insurance Services Podcast, brother. How are you?
Thank you. Doing well. Appreciate it.
Well, first of all, before we even get started, I just want to tell you welcome to the fam. This is your first time to be on the podcast, and we got to meet in, I guess, was it Houston where we met?
It's Houston. Absolutely.
Yeah. So, and I'm so glad to have you on the team. I know that Steve, the whole leadership team, we're glad to have you here. You're a wealth of experience and expertise. And that's exactly why we have you here today, because it looks like the government is going to reopen. And a big part of this shutdown and whether or not the government gets back open, and then even after it does get back open, a major topic is going to be what you and I live and breathe each and every day, which is ACA, health insurance, and the enhanced subsidies and all of this that's just kind of been in the news day in and day out. And I thought it would make sense now that it looks like we're reaching some sort of a solution, and now we're going to roll up our sleeves and either the enhanced subsidies go away completely, they stay for a little while. I thought it would make a lot of sense for our agents to hear just some back to basics information on what's happening. So with that tee up, let's just start right at the beginning. What are the enhanced subsidies?
So the enhanced subsidies were part of the American Rescue Plan of 2021. We're just coming out of COVID, still kind of the mix of it. The American Rescue Plan was passed. It gave eligibility, expanded eligibility to new members, and also increased premium assistance for eligible members that are out there. So if we go back to 2020 or 2014 when it started up to 2020, if you were in that 100 to 150% of the federal poverty level, you were, for the benchmark silver plan, which is your second lowest silver plan in any geographic, you were paying anywhere from 2 to 3% of your income for that plan. So if we fast forward to 2021 with the American Rescue Plan, what it did was it just shifted some subsidies that allowed access to more people to get plans. And it also gave more money for subsidies. So if you were paying 2 to 3% between 100 and 150% of the federal poverty level, you are now offered a free plan in silver for the benchmark plan, which is your second lowest silver. And then every scale has shifted over. So if you were 100 to 150, you now are entitled to a free silver plan. If you were 150 to 200% of the federal poverty level, you paid a higher percentage of your income. Now you're paying what was paid for the 100 to 150% of the federal poverty level. And it just shifted down the road and gave everybody a higher level of subsidy and made the insurance a lot more affordable. So this was put in place for 4 years. It was put in place in 2021, and it was due to sunset in 2025. So that is where we are now with the government, where they're voting on to extend these enhanced subsidies for another couple of years, or they sunset at the end of the year.
Okay, so I want to test myself on this. The reason why this happened was because COVID comes along. A lot of people are losing jobs. They can't go to work. So therefore it makes it tougher to just afford the health insurance they have. Also, there's increased medical needs and issues going on during the global pandemic. So am I understanding right, or stating this in the most simplest terms? The reason why this happened, what the American Rescue was rescuing us during a time of a global pandemic, and said, okay, for this period of time, even if you make more money, we're going to go ahead and give you more subsidy than normal because life has changed all over the world. However, this pandemic is going to end. So the lawmakers decided we're going to have it. This is going to have an expiration date.
Yep.
Likely whenever we get through this pandemic. And that's why the expiration was set. Because a lot of people will ask, well, why did they start giving extra subsidy and then just decide, okay, well, now we're going to take it away? But do I have that right? It was always from the get-go supposed to be temporary to get us through. That was kind of the thinking at the time it was put in place. Am I right about that?
Exactly right. It's a 4-year stretch, gets us through 2025, gets us back to level set. And when the enhanced subsidies go away, it goes back to the original Affordable Care Act rules from 2014 to 2021. So we're just going back to the way it was. out of these enhanced subsidies, enhanced premium help over the last 4 years.
And I think that's important to mention. That's one of the things that Steve McLaughlin's always saying is like, telling the folks out in the field that, hey, look, this is not something new. It's not like our industry has just been completely blown up. It's just going back to the way it was pre-pandemic, before the enhanced subsidies came into play. So we've been here before. People were making their living selling these plans before the enhanced subsidies. They'll do it again and they'll crush it, and everything will go. We'll adjust. So is that right?
That's exactly it. We're going back to the way it was.
Okay, very good. Now, the second question I have for you is this. What does it mean that the enhanced subsidies are going away? What does that mean? That just like, I think we may have just covered it, but is there anything we need to add to that they're going away because of this? And what does that look like, and how does it take effect?
Yeah, so the enhanced subsidies are set through the end of this year. So on 12/31, those increased subsidies are going to sunset. So it's going to go back to original ACA Obamacare rules as of January 1st. So right now we're quoting our members, we're looking at the rates, and we're looking at rates and subsidy based on original ACA rules. So if we go back to 2020, these are the same rates that we've been looking at with subsidy that we're looking at now. So when these are going away, the end of the year, it is going to go away, but we're quoting right now for 2026. So we're looking at the old ACA rates.
Okay.
Subsidies.
Now, okay, cool. Now, here's one of the things that I think a lot of people are going to want to tune into. And again, by the way, folks, one of the reasons why Mike and I are going over this is because you guys that are listening to this, our audience, and Mike, your first time on the show, just to let you know, the audience for this are the 25,000 plus agents we have out there in the field, as well as anyone that may not be affiliated with Agility, that you're just wanting to try to sharpen your knife as far as your knowledge on these products and kind of the business as a whole. And so I think it's important that we give you this information so that whenever you're sitting across the table from one of your clients to say, hey, this is what's going on, to prepare them. And some of those folks they've heard all the confusion, they've heard about the shutdown, and they're a little slower to enroll right now. And so this is so you can answer those questions and let them know, here's what's happening, and get them prepared. So just a little plug there as you're out in the field dealing with your actual client base. So here's a question to that end. Prices seem to be higher this year than last year. What's going on, Mike? Why is that happening?
Yeah, absolutely. So when the carriers were setting rates over the summer, they had to submit two sets of rates to CMS. One is if the enhanced subsidies are approved and they're extended for a couple more years. The second set of rates was if the extension doesn't go through, they're sunset at the end of the year. So with these enhanced subsidies, the ACA has grown by double over the last 4 years. We're about 12 million members when the enhanced subsidies were brought in, 13 million. Now we're somewhere close to 24 million members. As you have lower pricing, more people will get into the pool, more people getting insurance. A lot of people have gotten no premium plans. Some people, I'd call them free plans. Next year, when these prices are back to original ACA rules, people are going to have a premium. They're looking at their silver plans, which were free last year, and now there's a premium. And if you've ever had something free before and you say, hey, now it's time to pay for it, it's really difficult to get them to put that credit card down or that bank statement down to get them to make that payment. So the carriers, with the enhanced subsidies going away, had to put an increase in premium knowing that people are going to get out of ACA. And generally the people that are not going to pay for the health insurance are the healthier ones. So as the healthy ones are going to take a risk, they're like, I don't want to spend the $20-$30 or more, whatever their premium is going to be. They're going to take the risk and roll the dice this year and say, I think I can make it through. So those are getting out of the risk pool for the carriers. So if you go from 24 million, and I'm not going to try to predict how much we're going to have in membership at the end of the year, but let's say that we lose a few million members that are healthy. Now, the average member, when you look at the average membership, it's going to cost the carriers more per member because it's a sicker population. So the actual premium cost, not with subsidy, was less for the carriers that the carriers were putting out there for the members than without the enhanced subsidies. When you take away the enhanced subsidies, as people get out, it's a sicker population, you have to raise premium prices. So if you're quoting somebody from last year to this year that doesn't get a subsidy, you're going to see a considerable increase. But when you're looking at a subsidized member, it's still going to go back to original ACA rules from 2014 to 2020 that the 100 to 150% of the federal poverty level is still going to pay 2% to 3% of their general income.
Very good. And that's one of the things I think is a good question to answer. Like for those folks that are sitting there, again, across the table from a client, and they're just asking, well, I don't understand. I mean, again, a lot of people don't understand the basics of what you just said. They might think to themselves, wait a minute, you're telling me that all these people are going to decide I'm out, I'm not going to have health insurance. Well, doesn't that mean that's fewer people that they'll be paying claims on? And what you just said is very important. And it's very important to be able to explain to those people that are on the cusp of not being able to get that 100% plan and the premium may go up, is that yes, but the people that make that decision are those healthier folks. That's just the way this works. It's one of the sticky wickets of health insurance, right?
Absolutely.
Yeah. So, okay. So here we go. Here's another very important question. Again, for those folks out there in the field to be able to answer. What can a consumer do if they can't afford the increases we just talked about?
There's a couple different options. So we're looking at silver. Silver is where all the magic happens for ACA. The plans have the cost sharing ability. So if you're making 100 to 150% of the federal poverty level, your plan is indemnified at a 94% actuarial value. That's stronger than a platinum plan that you can buy on healthcare.gov. So the majority of the people buying silver are going to be between 100 and 200% of the federal poverty level. So the carriers are in essence paying a 94 actuarial value plan or an 87 actuarial value plan, which is stronger than a gold. The 94 is stronger than a platinum. So they have to price for that. So they build additional pricing into those silver plans. So when you're buying it online, if you look at the pricing with silver compared to a gold or a bronze, it's going to be quite a bit higher or up to gold or maybe a little bit higher because the max out of pocket's $1,000 and the health insurance carrier needs to indemnify that. So they've got to build in premium to help cover the cost of a plan that's paying out at 94% by the carrier and 6% by the consumer. So what I would do if my client says, hey, Mike, I can't afford this. This silver plan's too expensive this year. The first thing I'm going to do is look to buy out. And I know that sounds strange. Look to gold. The gold in a lot of areas is much less expensive than a silver. You might be able to get your clients a free gold plan, and that's 80% actuarial value, whereas silver, a core silver 70 and a bronze is 60. So buy up first. Take a look at the gold in your area. A lot of times it'll be equal to or less expensive than a silver. If that doesn't work, go ahead and look to bronze. Make sure you get that client covered. If you have a $10,000 out of pocket, you're going to get treatment. If you have a cancer, you're going to be seen in the hospital, and you can help prevent like a medical bankruptcy because you're going to have a stop loss of that $10,000.
Terrific. Now, bronze plans, they have a high out of pocket. And so for someone with a lower income, that could be kind of tricky. Is there anything we can do for those folks?
That's a great question. This one actually hit me personally. I was on a high deductible HSA plan several years ago, and it's $6,000-$7,000 out of pocket. That's a strong bill you got to pay if something happens. So I did get ancillary products. I was looking at the heart attack and stroke, the accident plan, critical illness plans, something that I could fill in the gaps if something happens. So I got an accident plan. I was involved in athletics. So like the chances are I'm still pretty young. I'm not going to get the cancer, heart attack, stroke. What's going to affect me is going to be an injury. And I did. I tore my arm up, had to have surgery, and my accident plan paid out and it covered the deductible max out of pocket. So I was not feeling the pinch of coming out of pocket for that high deductible HSA plan. So it was much easier for me to pay a small premium price for that accident plan, have a higher deductible. I was a little bit indemnified against some loss there.
What the heck are you doing out there, dude? You MMA fighting or something? What's up?
I was trying. I was actually in a Savage race, and I was on the bars, and I got stuck. I just hanging by one arm, and the bicep popped.
Oh, okay. I've had the exact same thing. So one time, Jake Frost, our colleague, he can attest to this. So we're in business school, and we had during one of our leadership classes, we're out doing a ropes course. And we had the wall where the team has to all get over, and then you leave the one behind. You got to figure out how to get that one over. Okay, so being the geniuses that we were, one of my buddies and I decide that we're going to reach our arms down, and John Perry, who's an incredible athlete, was a collegiate swimmer, he's going to run, he's going to jump as high as he can. We're going to grab his arms in the air and pull him over. So think about this. This is how smart this was, Mike. My arm is completely laid out flat, and I'm going to try to grab a grown man and pull him over. Same thing, dude. I grab his hand, pull him, and then just pop. And all of a sudden my left bicep just makes a little ball.
Yep.
It tore that tendon right there. So been there, done that, my brother. So I hate to hear that.
You need
for
an
you.
accident policy.
Oh yeah, exactly. Fortunately, I was good to go, but those are the things that you just mentioned that kind of to tie a bow around this, that I would like to say to those folks out in the field is that you've got to understand where people are. That's the beautiful thing about Agility Insurance Services that makes us different. And I know every FMO, every general agency will say that we're different and here's how we are and here's why we're great. But it truly is the way that Steve and this team has built this organization, is to be a grassroots marketing team, to know our members, know their lives, know their children, know what they do, know their demographic, all these things, so that we could say, dude, I know you're out there doing Spartan races and crazy stuff. If you're going to go for this high deductible plan, let's go ahead and make sure you got the coverage you need that meshes with that. And I think that's why conversations like this are so important, is because this is just a time to kind of test our skills, right?
Yep.
To test, okay, do you truly understand your member and the products? Yes, the product is changing, but the member is not. And for the most part.
Mm-hmm.
So you just got to figure out what's going to work for them. It's not like we're just completely rewriting the rules on this stuff, right?
Right. No, absolutely. So it's great for the members, it's protecting them. It's great for the agent, it's additional income stream, and you're doing the right thing for the client by assessing their needs. So yeah, I think it's a great fit.
Well, I think this has been great, Mike. I really appreciate you coming on and sharing your big brain with the folks out there, with me. I mean, this is how I learn. And to the agents out there in the field, the brokers, and those folks out there that are actually making this happen and going through this open enrollment, you got this. I mean, that's why you do what you do. You are a professional. We made up the term a long time ago on this show, Mike, that these are the insurepreneurs. These are the entrepreneurs out there in the insurance space that are the CEOs of their own organization of one, and they're going to make this happen. And hopefully this information helped them today. And with that, you got anything else to add, brother?
No, just have a successful OEP.
There we go. All right, Mike, thanks for joining us, folks. Thanks for listening to the Agility Insurance Services podcast. We really appreciate it.